Commerce Alive Today presents
Stage Stores. Stage Store's operating history dates back to late 1988 when, through a leveraged buyout, the former management team of Palais Royal Incorporated, Bain Capital Funds, and Acadia entities formed a separate company named Specialty Retailers Incorporated acquire Palais Royal, a retail chain of 28 stores. Concurrently, SRI acquired Bealls Brothers Incorporated, which operated 126 stores. Both Palais Royal and Bealls were family-owned, Houston-based apparel retailers that since the 1920s had built strong regional franchises in the central and southwestern United States. Palais Royal focused mainly on the operation of large stores in metropolitan markets, while Bealls' business consisted primarily of smaller stores in rural markets. SRI's management team focused on integrating Palais Royal and Bealls and refined the retail concept that would differentiate the company from both department stores and specialty stores. SRI stores offered more convenience and customer service than were usually found in department stores, provided leading brand names of apparel, and made available a broader assortment of merchandise than could be found in specialty stores. Palais Royal had relied on automation to improve operating efficiency, as evidenced by its early implementation of an automated personnel scheduling system, electronic point-of-sale cash registers, and a credit application and behavioral scoring system. SRI recognized the advances Palais Royal had made in automation and developed a retail concept that relied on efficient operating systems, advanced technology, centralized decision-making, and tight control of operating expenses. In about 18 months, SRI substantially completed the consolidation of Bealls' general and administrative functions into those of Palais Royal. Within 3 years, underperforming Bealls stores had been closed and the financial performance of the remaining Bealls stores had significantly improved. Expenses of acquisition and consolidation notwithstanding, SRI's net sales increased at a 3.5% compound annual rate to $447.14 million in 1991, from $403.9 million in 1988. According to Kenneth R. Peebles' story in the Houston Business Journal, in 1992 SRI wanted to go public and sought to raise $192 million in a dual debt and equity offering, but pulled back when the response was less enthusiastic than expected. Jim Markham, vice chairman and chief financial officer for Stage Stores, later commented that the filing was made in anticipation of future growth. Because the future growth really hadn't been executed yet, they just felt you couldn't get the best valuation for the company, so they withdrew the filing. Undaunted, SRI focused on growth through additional acquisitions and consolidations of complementary apparel retailers, improved sales performance of acquired stores, and opened new stores, especially in small rural markets. In June 1992, the company acquired Colorado-based Fashion Bar Incorporated, a family-owned business having 71 stores, of which approximately 75% were comparable to Palais Royal and Bealls stores, while the remainder were small specialty stores. Including Fashion Bar, as of June 26, 1992, SRI operated 230 stores in Texas, Colorado, Oklahoma, New Mexico, Alabama, California, and Wyoming. When SRI reviewed its operations for the 1988-92 period, it could pinpoint the special features that distinguish Palais Royal and Bealls from other apparel retailers, namely, store size, layout, and location, merchandising strategy, customer service, operating systems and technology, and growth strategy. The format and locations of the Palais Royal and Bealls stores offered a convenient and efficient shopping experience to customers. These stores, smaller than typical department stores yet larger than most specialty stores, accommodated apparel and accessories for an entire family. The stores were small enough for strategic locations in rural markets where the company faced limited competition, or inconvenient locations in outlying metropolitan areas. The company used a multimedia advertising approach to position its stores as the local destination for fashionable, brand-name merchandise. In the early 1990s, consumers in small markets usually had been able to shop for branded merchandise only in distant regional malls. Consequently, SRI's merchandising strategy focused on the traditionally higher-margin merchandise categories of family apparel and accessories. The company emphasized excellent customer service and promoted its private label, credit card program, which in 1991 included over 1 million active accounts and contributed approximately 60% of net sales. Early in its history, Palais Royal had applied highly automated, integrated systems to reduce operating costs in labor-intensive areas, such as merchandising, credit, personnel management, accounting, and distribution. These proprietary systems increased sales per square foot, reduced markdowns, lowered overhead, increased efficiency, and allowed store personnel to focus on customer service and selling. Furthermore, automation allowed buyers to select and allocate merchandise according to the local demographics and sales trends of the various stores. The company's successful experience in choosing complementary acquisitions and the timely consolidation of Bealls brought out several facts. Firstly, many family-operated apparel retailers had healthy customer franchises but were underperforming due to lack of advanced systems and buying economies. Secondly, gaining market share through acquisitions was generally more economical and offered greater opportunity for rapid growth than opening new stores. In order to eliminate the possibility of having Specialty Retailers Incorporated be identified as only a specialty retail chain, in 1993 SRI's board of directors formed Apparel Retailers Incorporated, which concurrently became the parent company of SRI. Management recognized the potential of a unique franchise in small markets and committed the company to several initiatives for bringing about the full realization of this potential. These initiatives included recruitment of a new senior management team, expansion in new markets through store openings and strategic acquisitions, emphasis on customer service and aggressive promotion of RE's proprietary card, continuing refinement of RE's concept, and closure of unprofitable stores. On July 1, 1993, Carl Tucker, who had 25 years of administrative experience in the retail industry, was chosen as RE president to lead the company's growth. A year later he became chairman and chief executive officer. Tucker succeeded 70-year-old founding president Bernard Fuchs, who retired after having been in the retail industry since 1944. The results of the Bealls Ladyman acquisition confirmed the value of RE's strategy for growth. The acquired stores posted an annual sales increase of 78% and a store contribution margin more than twice that of the previous year. The company also opened 23 new stores. Total RE sales increased 17.4% to $682.62 million in 1995, compared to $581.46 million in 1994. This increase was due in part to increased sales from 23 stores opened during 1994-95. The increase, however, was partially offset by the effects of the store closure plan and the 1995 devaluation of the Mexican peso, which negatively impacted sales at the 6 Bealls stores located on the Texas/Mexico border. In keeping with its strategy of controlled geographic growth, RE completed its second major entry into small markets with the June 1996 purchase of Gordmans Incorporated, a privately held retailer with 34 locations in Ohio, Indiana, and Michigan states where the company previously had no stores. These stores were similar in size and content to RE's existing stores and were compatible with the company's retail concept. The company opened 35 new stores in the central United States and reported record sales of $776.55 million for 1996. On October 25, 1996, more than 4 years after filing and then withdrawing an initial public offering (IPO) with the U.S. Securities and Exchange Commission, Apparel Retailers Incorporated changed its name to Stage Stores Incorporated, completed another IPO by selling 11 million shares of common stock at $16 per share, and began to trade on the NASDAQ. In conjunction with its stepped-up expansion strategy, Stage Stores applied its small market retail concept to micro markets and communities with populations of from 4,000 to 12,000. The company capitalized on its favorable operating experience in scaling its store concept to an appropriate size of less than 12,000 square feet to operate in these small markets that generally had lower levels of competition as well as low labor and occupancy costs. Mann & Myers's analysis of the regional family apparel sector found that there were 22 companies operating more than 850 stores generating $2.3 billion. Within the relatively short span of less than 10 years, Stage had recognized the latent opportunities in this market, noted the emergence of new lifestyles. For example, career women did not spend as much time shopping for the family as did the women of earlier decades, and developed a retail strategy based on convenient locations where all the family members of small communities could find nationally advertised, branded apparel. With the June 1997 purchase of C.R. Anthony Company, Stage Stores strengthened its position as the dominant branded apparel retailer in small-town America. Anthony's consisted of 246 family apparel stores located in small markets in 16 states. The largest concentration of stores was in Texas, Oklahoma, Kansas, and New Mexico. Approximately 87% of Anthony's stores were located in small markets and communities having populations generally below 30,000. During the 1997 calendar year, Stage converted 130 of the acquired locations to its format, primarily under the Stage and Bealls trade names. The final group of the other 105 stores were converted and included in Stage's operation by the summer of 1998. The 11 Anthony stores that were located in overlapping markets were closed. Acquisition of the Anthony stores gave Stage the opportunity to accelerate its expansion program in existing markets and to extend its presence in new markets. Both companies benefited from synergizing their administrative infrastructures, leading, for example, to cost savings on overhead and enhanced opportunities for increased revenue and gross margins. Sales for 1997 increased 38.2% to $1.07 billion from $776.55 million in 1996. As mentioned above, Stage stores operated under three different store nameplates: Palais Royal, Bealls, and Stage. Both the Stage and the Bealls nameplates identified the company's small market stores. The company kept the two nameplates because Bealls was so well known in its home states. The Palais Royal nameplate identified the company's larger market stores located in suburban neighborhoods and high-traffic strip centers, mainly in the Houston and Galveston areas. Although these large stores generated a significant amount of cash, which the company applied mainly to continue expanding into small market stores, their profit margins were lower than those of the smaller stores. Stage continued to focus its growth primarily on small markets and did not plan significant expansion of the Palais Royal stores. On March 25, 1998, Stage stores announced that the Office of the Comptroller of the Currency had granted the company preliminary approval of an application for a credit card bank charter. Pending further approval by the FDIC and the completion of all remaining conditions, Chief Financial Officer James Markham stated that the company felt confident that we will begin to see the economic benefits of the bank by the end of the third quarter. At this period in its history, the company had more than 2 million active credit accounts, and proprietary credit card purchases accounted for approximately 51% of the company's sales. Final approval of the bank charter allowed Stage to maximize fees and rates, the majority of which were subject to limits set by each state. In April 1998, Stage began trading on the New York Stock Exchange. Sales for the first quarter of fiscal 1998 peaked at a record $272.2 million, a 42.1% increase from 1997 first quarter sales of $191.5 million. Shares of stock rose to the $44-52 price range, compared to the $16 price per share when the company went public in October 1996. During fiscal 1997, the company's store count almost doubled, going from 315 stores in 19 states to 606 stores in 24 states as of January 1998. Furthermore, Stage clearly demonstrated that it had the ability and wherewithal to successfully open and convert a significant number of stores. As the 21st century drew near, Stage stores continued to implement its aggressive small market growth strategy through organic store openings, strategic acquisitions, and efficient consolidations. In June 1998, the company gained a foothold in the Pacific Northwest through the acquisition of 15 Tri-North department stores in Montana, Nevada, Oregon, and Washington. Upon completion of the acquisition, Stage completely remodeled and re-merchandised the stores. They were opened under the Stage name and format in the early fall of 1998. For the near future, Stage identified 6 viable acquisitions of privately held companies having a total store count of 425. The company's total vision, however, encompassed 1,200 potential U.S. markets that met its criteria for remaining the store of choice for well-known, national brand name family apparel throughout America's small towns and communities. In 2003, Stage stores acquired 136 Peebles stores located in 17 states. The company purchased the Goody's name through the Goody's bankruptcy auction in 2009. The nameplate was used in markets with a strong customer awareness and brand recognition of the name. In 2011, Stage stores began a new chain called Steels, but in March 2014 it was announced that these stores are being sold to Hilco Global. Stage stores acquired the Gordmans assets in March 2017 after becoming the winning bidder in a bankruptcy sale. The company announced that it planned to run at least 50 stores in one of Gordmans' distribution centers. Under the direction of Stage stores, Gordmans began to transition away from the specialty department store business model, moving the brand to the off-price retail sector, more resembling stores like TJ Maxx, Ross, and Burlington. As part of expanding the brand, Stage stores opening their first new Gordmans store in Rosenberg, Texas in March 2018. In March 2019, Stage announced that by mid-2020 they planned to convert at least 220 of their current department stores, including those of other brand names, into Gordmans off-price stores. CEO Michael Glazer cited the high sales increases in the locations that were converted in 2018 as the deciding factor in the decision. In September 2019, Stage Stores announced that they planned to completely exit the department store market, moving completely to the off-price model, converting all other stores' brands to the Gordmans brand, and operating approximately 700 Gordmans stores by the third quarter of fiscal 2020. On September 17, 2019, Stage Stores announced plans to convert all remaining Stage, Bealls, Palais Royal, Peebles, and Goody's department store locations into Gordmans stores by the end of 2020. This would mean that Stage Stores would completely exit the department store market and instead go all in as an off-price retailer. By the end of fiscal year 2020, Stage planned to operate approximately 700 Gordmans stores. CEO Michael Glazer cited the high sales increases in locations that had already been converted as the main factor in this decision. After the COVID-19 pandemic caused most of its stores to temporarily close, Stage Stores announced that it would enter bankruptcy proceedings and liquidate its inventory, except for individual stores for which it could find a buyer. On October 21, 2020, Stage sold its intellectual property and a distribution center in Texas to Florida-based Bealls Incorporated for $7 million. Notably, this allowed the Florida chain to use the Bealls name nationwide. Previously, Stage owned the rights to the Bealls name nationwide, except in Arizona, Florida, and Georgia. Bealls also acquired the rights to the names of Stage's other chains, as well as all of its private label brands and customer lists. In 2022, New York-based online company Brandex acquired Stage Stores, Goody's, Gordmans, Palais Royal, and Peebles, as well as their private brands and plans to relaunch them online.
You're in for a big surprise at the Stage One Big Sale. It's our 50% off 3-day doorbuster event, starting Thursday 1 p.m. through Saturday 5 p.m. 50% off almost everything, only at the One Big Sale, only at Stage.
If you have any fond memories, please indicate it at the comments below. Thanks for watching, subscribe, and like.